Hi, this is John Graham from Neighborly Financial in Roseville, California, and I'm here today to talk about FICO scores. FICO stands for the Fair Isaac Company that developed this scoring system. It's a number between 300 and 850. Anything below 620 is considered bad credit. Between 620 and 720, it's considered marginal credit. Anything above 720 is considered acceptable. And again, this video is just kind of for general information. It's not to be taken as legal advice. FICO scores are not about income, assets, or employment history. The FICO score is about your debt and your history of paying off that debt and your expected ability to do so in the future. There are several factors that go into the FICO score. Approximately 35% of the score is based upon your payment history. And they're going to look at bills that you pay, they're going to look at bankruptcy, any late taxes, and just some information on this. Recent lates count more than lates that occurred 2 or 3 years ago. The larger amount of the late payment and the later it is, the more impact it has on your scores. So the major factors that they look at here is if you've ever had a bankruptcy or a foreclosure or a repossession or a write-off or a collection. These count much more heavily than a late payment. The second major category, about 30%, is based upon outstanding balances. This is the percent of the total amount that you can borrow. For example, on a credit card, if you have a $10,000 balance or a $10,000 limit and you have a $5,000 balance on that, that means you're at 50% of the maximum of the limit. So about 90% of this category is based upon credit cards, and you want to keep your balances as low as possible relative to the maximum limit. So if you can get down to 20-30%, you're much better off than if your balances are 70 or 80% of the limit. Really paying off your credit card really doesn't help much. They kind of look at the average balance throughout the month and not the amount that you've actually paid. And it's interesting, ironically, paying off a debt actually counts against you, and opening new credit also counts against you. If you have 2 cards and one's maxed out and the other is empty, you're better off putting an equal amount on both cards. Moving on, the next major category, about 15% of the FICO score is based upon the average length of time that you've had credit. So closing a credit card reduces your score. If you've had a card for a long, long time, it actually helps improve your score. Another major category, and about 10%, is based upon inquiries into your credit history, the number of times you apply for credit. Promotional inquiries and account reviews don't count. So for example, if a credit card company sends you a flyer in the mail that says you're pre-approved, that doesn't count against your credit score because they've already done a credit check to see if you qualify for the card, but that doesn't count because that's a promotional inquiry. And then another thing is all mortgages and auto inquiries within a 14-day period count as one inquiry. So if you're applying for a car loan and you go to 4 or 5 different dealers, those don't count as separate accounts. Those are all kind of one. Then the last one is 10% of the total FICO score is kind of the types of credit, and there's a difference between the installment credit and revolving credit. So for like a credit card is a revolving credit, whereas an installment loan would be for like a car. And in the end, what does it all mean? Higher scores mean lower costs on a mortgage. So up to a point, and when you get up around 750, you're about as good as you can get in terms of getting a mortgage. But then obviously the lower you go, the more it's going to cost you on a mortgage. If you have questions, go to our website, and there's a site out there that is linked to from our website. And you can go out and you can find more about the FICO scores, and you can also go online and find out what your actual FICO score is. It usually runs about $15 to $20. And again, this is John Graham from Neighborly Financial in Roseville, California, and you can find us on the web at www.neighborlyfinancialmortgage.com, or you can call me at 916-799-4336. Again, I hope you enjoyed the video. Thanks.